Bandhan Mutual Fund presents MF Corner.
Hello, welcome to the special edition of MF Corner on YouTube. Thank you so much as always for tuning in. What we're going to discuss today is going to be the mistakes that you as an investor should avoid while investing in mutual funds. There are a lot of them that we all make, but what are the top ones that you make? How can you avoid them? And to help us solve all those doubts in terms of avoiding these mistakes, we have Ajit Menon, the CEO at PGIM India Mutual Fund, joining in with us to help us solve those doubts, help us get through those mistakes that we commonly make. Ajit, thank you so much for joining in with us on this special edition of MF Corner on YouTube. Let's just start by the basics. Why focusing mostly on past performance, which is, I think all of us do that. Oh, this is what they've done in terms of mutual fund. They've performed like this. Why past performance could become a mistake while selecting a mutual fund? And what factors as an investor should I look at beyond just my past performance?
Vinnii, that's a great question. And I think, all of us, if we just need to have a reference point, and usually the reference point for us is, how have these products been doing in the past? Now, the only thing to remember here that this is past performance, right? And you hear that famous mutual funds are subject to market risk, and read often documents, and the fact that you should, when you're looking at that past performance, you need to remember that you're investing for the future. And I think the only mistakes that can happen here is focusing on that performance number of a specific time frame, right? And commonly what happens is people look at maybe the last 1 year return or the 2 year return of a product and the market and think about that this is probably going to last forever. Right? If it's a bad performance, people worry about it and say, hey, it's not the time. Or if it's a good performance or great performance, you would say that, hey, this might last forever. I think that's one sort of error to sort of avoid. One should be looking at what's a little more longer time frame of return. And I would suggest a 5-year plus time frame of return in terms of judging what can you probably expect from this going forward. Looking at 1 or 2 year past performance is where one of those errors come in. Two is, I guess more sophisticated investors would look not just at that performance numbers that we see on websites, but they would do a little bit more research to think about what's the risk adjusted return of this. And there are ratios and there are research that you can do yourself to find out, okay, how is this really doing? How is it on a rolling return? Not on a from one point to the other point. How is it doing there? How is the risk ratios? That's one. And the third is, what returns are you looking at? Are you looking at the broad market returns to sort of take a decision? Or you're looking at a list of funds and they could pretty much be sectoral, thematic products that are doing really well at that point in time. And so you should look at a far more broad-based index kind of return over a long period of time to start making a judgment of how you should be thinking about what to expect. That's one way of not looking at when you're looking at past performance, what you should be doing or what you should be looking at. And I think the second is, and I guess this is a little bit more, I think learning a little bit about it. And the way that I think about it, Vinnii, is that broadly, you're looking at these fund managers out there who obviously experts who come on TV like we are speaking now and talk about various things. There are broadly about 4 or 5 styles in which these managers manage money. They typically don't change those styles over their careers, right? They could be very growth oriented, or they could be very value oriented, or they could be quality oriented, like we are at PGIM mostly, or they could be momentum oriented. And you've heard these terms. And the best way is to really mix all of the 3 or 4 styles. If you've done your research to say, I like this fund manager, let me find out the style. Oh, he's a growth guy. Okay, this guy's a quality guy. This guy's a momentum player. Let me mix all of these 3 or 4 in my portfolio. And the reason I say that, Vinnii, is that these styles go through their cycles. So sometimes when you're looking at something that's performing well, there's a style or 2 that's doing well in that cycle of the market. And if you put all your money there, you run the risk of concentrating your investments in a style. And to put it simply, why is that a problem? It's a problem because if you open up your portfolios, you're probably likely to see the same stocks across all those portfolios, right? And what you want is not just a diversity of the number of schemes, but the diversity of the portfolio within that scheme. And that's why mixing these 3 or 4 styles is one good little research to do as you look at this particular topic.
Absolutely. Ajit, what I commonly see also, what is a mistake that I feel people normally try to time the market time and again, all market experts, mutual fund experts keep telling everyone, but do not try to time the market.
Right.
Instead, spend more time in the market is what I've heard everyone say. But this is something that everyone is like, oh God, is it at the lowest point? Should I start increasing my SIPs now, or should I get out of it because there's an issue coming in, or there's volatility there? How would you help, or what are the dangers maybe that you could point out for our viewers that why they should not be doing that?
Well, I think one way of thinking about it is, how do you define yourself? Are you a saver? Are you an investor? Or are you a speculator? And there is a difference between all the three. We tend to have all of our conversations saying investors, investors, investors. But if you look at data that's put out by SEBI, even if you look at mutual fund data as to how long do people hold on to their portfolios, it's about a little under 3 years. It seems like in India, you have either savers or speculators. You have very little of investors. And I think defining yourself as an investor means knowing your goals and your timeframes to those goals. If you take that approach and you've heard of, Warren Buffett and all of that, he's been in the news lately for the reasons we know. The thing is that once you are thinking as an investor, you then are thinking about why are you doing what you're doing? What's your time frame? What are the goals that you have? That becomes a more stable, structurally strong way of planning your investment. When you think about, I just want to create wealth and I want to do it, quickly, and I want to make this money and others are making it too, and you look around, and that's when you get swung by saying, let me time the market. Maybe this is a wrong time or a good time. So when you do that, when you start thinking about timing your market, you could end up with, quite a bit of losses. And we spoke about this, Vinnii, that, and even if you looked at it, not just for Indian markets, even if you looked at it for the US markets, and again, I was reading this article by Devina, and she says that, and she's computed saying that, the US markets, the S&P 500 has a 100-year history. If you had put $100 in, 100 years ago, and if you had missed just the best 50 days in the 100 years of the S&P 500, today you would be sitting on less than $100. Can you imagine that? Over 100 years. And you have the same thing as an example for the Indian markets as well. We did a little bit of a study from 2001 to 2024. If you had put 10,000 rupees at that point of time and you had not touched it, you would probably be sitting on, sort of 3.5 lakh rupees thereabouts. But if you had, sort of missed the, top 50 days over here, you would probably be sitting on 11,500. Your 10,000 would have just grown to 11,500, just missing the top 50 days since 2001 to now. So I think that's the danger of timing the market. I think you can never sort of really get it right, even if markets are corrected. If you have a long time frame as an investor with goals and time frames, it's good you're literally buying some good equities at a discount. I mean, changing that attitude can help.
Absolutely. Ajit, one thing that you did mention previously was over-diversification, or how to the diverse portfolio. Now, I don't blame someone who's looking at the mutual fund industry. We're spoiled by choice. We have so many options, whether it's sectors, balanced advantage funds, hybrid funds. There's so much there to look at it. How can over-diversification also actually lead to a problem? Is that a problem, or is that a mistake that one should avoid?
I would say it's a mistake that one can avoid because there is cost involved in that over diversification as well. And there are various other reasons, and let me touch upon that. So I think when we think about diversification, what I think the starting point for people has to be diversification across asset classes, which means I have a little bit of equity, I have a little bit of bonds or fixed deposits or, fixed income products. I have a little bit of gold. I have a little bit of international equities. and so on and so forth. And people, younger ones, they can think about Bitcoin or paintings and things like that people do, right? And more high net worth people would think of alternate products in AIFs and PMSs, which are also equity in a manner of speaking, but there are different categories there as well. So I think the first point is have a diversification that you can across asset classes. The problem of over diversification, according to me, Vinnii, is within an asset class. When you get into one asset class in equity and you think that you're going to have these 10 or 15 funds that you believe are good, the problem there could be that you're attracted to one style or two, and you've got all of this portfolio, and you would end up with what I would call overlaps. You're just replicating the same thing across this because you might have invested at a point in time when these funds were doing well, and that's a natural tendency. And that, as I mentioned before, is because a couple of styles are probably doing better at that time. I remember meeting a financial advisor on a trip to the US in my earlier company, and he's saying that, I recommend the worst performing funds to my customers in a point in time when they want to put money, because I know they're going to be they're going to be higher up in the next cycle. So when he says worst performing, it's not as if he's not done his due diligence. He just simply means that sometimes styles are out of favor, which means you're getting those portfolios at a discount. And thinking about getting things at a discount is a good way of thinking about it, and why you should therefore, in your diversification, not over diversify with similar kind of products. Diversify across different styles of investing so that you don't have overlaps, and these styles will rotate. You can't predict it, but your portfolios will be better off than the average investor, and that would be a smart choice to make.
Absolutely. Diversify in different asset classes.
That's
Don't diversify in the same asset class with different portfolio, different funds. That doesn't help you. But yes, that's an important one. Ajit, are there any other mistakes that you've seen investors make, or maybe that's something that when they're looking at is something they could avoid? If you could note that out for us.
Vinnii, I would only say that ultimately it's our money, and people are looking at making returns and want to create wealth. But I'm using my own example of saying that we spoke about psychology and about the biases that we as all human beings we go through. If you go through Google, you'll know that even Newton, one of the most intelligent people on earth, he lost money investing in the stock market in the South Sea bubble, as it's called. So, as Warren Buffett likes to say about corporates in a recent interview that I read, he said, the absence of stupidity is more important than the presence of genius. You don't have to be very intelligent. What you need to really have is the common sense of saying, what's the purpose of my investment? It's for my children's education. It's for my retirement. Please remember, in all of the financial goals of your life, retirement is the only financial goal for which you don't get a loan, a conventional loan. Products like a reverse mortgage is not very mature in India. But when you're investing for your children's education, you can take an education loan if you have a gap. You're doing it for a house, you can get a house loan, a car loan, a business loan. There's no retirement loan, right? So prioritizing your goals is one mistake I could probably point to, saying that have your priorities right. And retirement, I would say, should be your number one priority, simply because it can benefit from compounding long term. It's also the only financial goal for which you don't get a loan. You've got to do it, right? So I would just point to maybe that point that people can sort of keep in mind. Having a goal, having a plan, having an advisor. A lot of people want to do it yourself, sure, but there's no harm in taking a second opinion like we do with our doctors. That could really help.
Absolutely, Ajit. Thank you so much for joining in with us, helping our viewers, maybe avoid the mistakes they could be making. Also, retirement, yes, I'm going to start checking that out for myself as well. I'm not going to get a loan for that, so I'm going to be prepared for that. But Ajit, thank you so much for joining in with us and helping our viewers,
Thank you,
solve issues as well.
Thank you, Vinnii.
Bandhan Mutual Fund presents MF Corner.